Welcome back, everyone. I am absolutely thrilled to have you here today. In this explainer, we are diving deep into what I consider the absolute ultimate financial goal, building a genuinely stress-free portfolio using zero-cost stocks. Look, we all know the deal. In a world of constant economic noise, relentless inflation, and these wildly unpredictable global markets, holding onto your investments can honestly feel like riding a roller coaster without a seatbelt. But today, we're going to completely flip that script. We're going to look exactly at how you can hold highly valuable, wealth-generating assets without risking a single penny of your original capital. We are stripping away all the complex jargon, and we're going to build a very clear, step-by-step methodology for bulletproofing your wealth. Okay, let's dive into this. So, I want you to ask yourself a question. What if you could hold stocks with absolutely zero financial risk? Just pause and really let that sink in for a second. For pretty much all of us, investing is fundamentally tied to this baseline level of anxiety, right? Markets swing wildly, economies shift overnight, and especially if you're investing in emerging or highly volatile markets, you know what? That constant anxiety is completely justified. You hit that buy button on a stock, and immediately, almost instinctively, you start worrying about it dropping below the price you just paid. But what if we could mathematically and systematically just eliminate that worry entirely? What if you could hold an asset completely fearlessly? That profound peace of mind? That is the exact power of a zero-cost holding. Here's our roadmap for today's explainer. We're climbing a ladder of complexity here. We'll start with number 1, the core concept of the zero-cost portfolio. Then number 2, strategy 1, looking at passive dividend income. Number 3, strategy 2, moving into active trading. Number 4, strategy 3, our most advanced defensive tactic, futures hedging. And finally, number 5, achieving true financial freedom. All right, let's kick things off with section 1, the zero-cost portfolio. So what do we actually mean by this? Well, zero-cost accumulation simply means recouping your initial investment entirely through the cash flow that the asset itself generates. Once you've earned back exactly what you put into it, boom, the holding becomes completely risk-free. Now, it's absolutely crucial to distinguish what this really means, because this is where a lot of people get tripped up. Just because your personal cost basis has reached zero does not mean the asset itself has no value. Not at all. If you bought a stock for $100 and over a period of time it pays you $100 back in hard cash, your cost is now zero. But you still own a highly valuable, actively wealth-generating asset. This completely shifts your whole psychology. You move from operating out of this constant fear of loss to confidently playing with what casinos call house money. You literally get to carry that asset into the future without any fear of losing your initial hard-earned capital. Think of it exactly like owning a free house. Let's say you go out and buy a rental property. Over the next 10, 15, or 20 years, your tenants consistently pay you enough rent to completely cover the original purchase price of that home. At that exact mathematical point, the house is essentially free to you. You've got your original money safely back in your pocket to spend or reinvest anywhere else you want, but you still legally own the physical house, right? And you still own 100% of its future earning potential. This zero-cost stock strategy is the exact same mental model. We're simply applying it to the liquid financial markets. Moving right along to section 2. Let's look at strategy 1, dividend income. Okay. We're going to look at a real-world case study here using the massive Turkish industrial giant Tüpraş, looking at the period from 2023 up to early 2026. Now, context is everything here. This was a famously frustrating period for growth. The local market index was caught in this brutal stagnation. It was battling intense inflation and essentially just moving completely sideways from about 8,500 to roughly 11,400 over almost 3 full years. Just a terrible, grinding period for sheer price appreciation. Yet, the cash flow never stopped. If you had bought Tüpraş in 2023 at an average cost of roughly 70 lira, over this totally stagnant, incredibly frustrating period, the company quietly paid out a net total of 55 lira in dividends per share. Just let that math sink in for a second. Even when the market as a whole practically refused to climb, the underlying business just kept doing its job, pumping out massive amounts of cash directly into its shareholders' pockets. So completely passively, literally just by holding the stock and collecting those scheduled dividend payments, an investor would have recovered nearly 90% of their initial cost basis in a broader market that basically went nowhere. The financial risk of holding that specific asset was almost entirely neutralized, and it actually gets significantly better when you zoom out and look at the compounding effect, because those dividends didn't just have to sit there idle as cash in a brokerage account doing nothing. During those 3 years, that 55 lira could have been actively reinvested. You could have put it into physical gold, foreign stocks, high-yield deposits, further compounding your overall wealth, all while your original stock position quietly became mathematically risk-free. It is a phenomenal wealth engine. Now, what's really interesting is that Tipperish isn't just some isolated anomaly. Take Ford Automotive during that exact same tough market period. Back in early 2023, the stock was trading around the 50 to 60 lira band. Over just the next 2 years, the company paid out 20 lira in net dividends. So within 24 months, half of the initial purchase cost was entirely erased, wiped out, paid back directly to the investor in liquid cash, even while the stock's actual price action was incredibly sluggish. This is so crucial because it proves that you do not necessarily need a raging, euphoric bull market to aggressively buy down the risk in your portfolio. Patience and solid fundamentals do the heavy lifting for you. 130 lira. Now, if notoriously stagnant markets can wipe out half your cost, what do you think happens during a genuinely good market period? Well, let's look at Doish Automotive. If you bought the stock in 2019, your average cost would have been a mere 4.5 lira. By 2021, which is just 2.5 years later, mind you, your initial investment was entirely paid back through dividends. Your personal cost basis was officially zero. You were playing entirely with house money. But what if you just held on until 2025? The total dividend payout reached an astonishing 130 lira. That is almost 40 times the original purchase price, generated purely in cash payouts. No selling required. So the absolutely crucial point to take away here is this. To make this strategy truly effective, you have to filter for companies with a proven history of long-term USD-based dividend growth. Dollar-based dividend growth simply means the company's payouts are actively outpacing local currency devaluation. That acts as a true fundamental wealth builder, rather than just some illusion of profit that gets eaten away by inflation. You want aggressive growers, and you must for sure avoid companies where dividend payouts actually shrink over time in real dollar terms. All right, let's step it up to Section 3. Strategy 2, active trading. Okay, so here's the mechanical loop of zeroing out your cost using market volatility. Let's say you buy a stock at 100 lira. The stock rises a bit and you sell it at 105 lira. Shortly after, the broader market takes a natural dip and you buy the exact same amount of shares back at 97 lira. Look at what just happened. You now own the exact same asset, the exact same number of shares, but you have successfully pocketed 8 lira in pure cash. You didn't inject any new capital into the market, right? You simply used the asset's own naturally occurring volatility as an engine. So your personal cost basis for those shares is now effectively 92 lira. You just repeat this loop, selling the cyclical peaks, buying the cyclical dips, until the cash you have successfully pulled out equals your initial 100 lira investment. You still hold the full position, but you're getting it at a cheaper personal cost every single time you complete the loop. However, I want to be incredibly clear here about the reality of this approach. While this strategy dramatically speeds up the process of achieving a zero-cost position, it completely changes your overall risk profile. You absolutely cannot do this blindly. You can't just base it on gut feelings or some random tips you heard online. It requires a solid, fundamental education in technical analysis. You really have to understand support and resistance, which basically means knowing the historical price floors and ceilings where stock naturally bounces or gets rejected. You also have to follow clearing data to actually see what the big institutional buyers and the market makers are doing behind the scenes. It is inherently riskier because a poorly timed trade means you could accidentally lose your position entirely or be forced to buy back in at a much higher price, totally defeating the purpose. So it's high effort, it's high risk, but when executed correctly, it yields much, much faster results than simply waiting for annual dividend payouts. Which brings us to our most advanced section. Number 4. Strategy 3. Futures hedging. Let's see how this builds out. As long-term investors, our absolute worst nightmare isn't a single company having a bad quarterly earnings report. No, it's a massive macro shock. We're talking about those truly terrifying moments when the entire market index crashes, all at once, taking even the absolute best, most profitable companies down with it. Unpredictable global pandemics, sudden geopolitical wars, severe internal political crises, or aggressive, completely unexpected interest rate hikes by central banks. When these catastrophic events hit, it honestly doesn't matter how fundamentally brilliant your stock is, everything drops in unison. Long-term holders desperately need a structural shield, so they are never, ever forced to sell their precious, wealth-generating assets in a moment of pure market panic. And this is exactly where the futures market, often known locally as VOP in the context of our source material, comes into play. Think of it exactly like buying an ironclad insurance policy on your house. On the left side of the equation, you have your spot market position. That is the physical stock you actually own in your brokerage account. It's a long position, meaning it is totally completely exposed to the crash. On the right side, you open a futures market short hedge. When the market crashes, a short position actually makes money. Therefore, a purposeful, calculated mathematical loss on your physical spot stock is perfectly, and I mean exactly, offset by the massive profit you generate from your short hedge insurance policy. And here is the absolute magic of utilizing the futures market: leverage. Because of the leverage built directly into futures contracts, meaning a very small amount of money actually controls a massive amount of underlying value, you do not need a giant pile of cash to protect your portfolio. If you own, say, 100,000 lira worth of a foundational stock like Ford Automotive, you absolutely do not need 100,000 lira to hedge it. You only need to put up about 10,000 to 12,000 lira in a security deposit, which is officially known as margin. That tiny fraction of capital acts as an impenetrable shield for your entire 100,000 lira spot position. It is maximum protection for minimal upfront capital. It's brilliant. Okay, let's walk through this step by step so the mechanism is mathematically crystal clear. Because I'm telling you, this is where fortunes are protected. Step 1, you buy your spot stock, let's say at exactly 110 lira. Step 2, you foresee a major macro crash coming. Maybe a sudden geopolitical conflict flares up in the news. You immediately open a short futures position to fully cover the value of your stock. And let's say the market indeed violently crashes. Step 3, your underlying stock drops all the way down to 86 lira. At this exact point of maximum fear in the market, you step in and close your short position. You capture a massive realized profit from the short side, which literally pays you the exact cash difference of the market drop. Step 4, and this is the portfolio saving part. Because you pocketed the pure profit from the short contract, your new effective cost basis on that stock is practically reduced to 86 lira. You successfully rode a terrifying market crash down with zero financial damage, and now you get to peacefully ride the next upward wave from a mathematically lower baseline. Let's pull this all together in Section 5, Achieving Financial Freedom. We've really scaled the entire ladder today, haven't we? We saw Strategy 1, passively, patiently collecting scheduled dividends to slowly but surely claw back your initial capital investment. We explored Strategy 2, utilizing deep technical analysis to actively trade the natural volatility, systematically pocketing the cash difference to dramatically speed up that zero-cost process. And we just unpacked Strategy 3, deploying defensive futures hedging to instantly neutralize terrifying macro crashes and forcefully drive your underlying cost basis downward. But remember, the ultimate overarching goal of all three of these distinct strategies is completely identical. It's to deliberately transition your portfolio into a state where you are left holding highly valuable, wealth-producing assets with absolutely zero of your original capital left at risk. There is a guiding principle here from the source material that I really want you to let resonate deeply. Once you strip away the initial cost, you can carry your investments fearlessly into the future. I mean, that is true financial freedom, isn't it? It's not just about getting rich. It is the profound psychological relief of logging into your portfolio during a highly turbulent market, staring at an absolute sea of red, and knowing that mathematically, logically, your downside is zero. You aren't sweating. You are playing completely with the market's money, but you are keeping 100% of the asset's limitless upside. So I want to leave you with this final provocative thought. Take a hard look at your own portfolio right now. Look at the specific assets you hold today. Which of these three strategies will you use to start eliminating the risk in your portfolio? Whether you choose the quiet patience of dividends, the calculated precision of active trading, or the impenetrable shield of hedging, the clear path to a completely stress-free portfolio is sitting right in front of you. Thank you so much for joining me on this explainer today. It's been an absolute blast. Stay curious, stay focused, and keep learning. I'll catch you next time.